Okay, folks, welcome back to the Contrarian Trader. This is Robert Desmond. It is July the 18th, 2010. The last time I had posted a video on YouTube was back on July the 3rd. And at that time, I mentioned that we were probably going to see a rally in the markets, and I saved the reasons for that rally for my subscribers, which is only the right thing to do. And for those who listened, they would have enjoyed a very nice rally. Let's just take a quick daily chart of the S&P of the Dow Jones Industrial. This is July 3rd here. This is where I made the call. Now, what I was looking at that time were a number of different things. On the candlestick basis, you had these bottoming tails here. That was first and foremost. Well, not first and foremost. One of the factors. Secondly, you had divergences on the 10-year bond yield and the VIX. I won't go into them, but those are the three reasons why I felt that we were going to see a rally in the markets. So on July 3rd, the members' commentary, which I send out to the members, obviously, I mentioned the reasons why we should get long of the market, and for those who joined in, they would have realized a nice, healthy return. I mentioned that it would go on for no more than 2 weeks, and it didn't. It was a very limited rally. I believe that rally is over. Is there a reason to get, I won't say bullish, I will say cautious if you're short? There are those reasons, and I will go into those reasons with my members on the members version of this commentary this evening. So if you want to join in, please sign up for the 14-day free trial and get, just test it out. It's not going to cost you a penny. Cancel out through PayPal. But I will go into those reasons. But by and large, we remain bearish, very bearish on this market. Let's take a look at the weekly chart of the S&P 500. We are barely holding on to this 1050 level. We failed to break out above the 1100 level. On the Dow Jones Industrial Average, we barely held the 10,000 level. Now, if we are unable to hold, I'm going to revise downward our support level. We were able to hold that 1010 level on the S&P 500. If we fail to hold that level, and if we fail to hold 10,000 on the Dow Jones Industrials, I do believe that we will see, in a heartbeat, 975 on the S&P 500, and that's before Election Day. Now, last week we had earnings that came out in earnest. It really began with Alcoa. Now, Alcoa, the news came out, CNBC, beautiful earnings, great earnings. Can't believe it. They beat the street. Well, look at Alcoa. It gave it all back. It's down below where it was before they announced their earnings. JP Morgan came out. What did they do? They beat the street. Better than earnings. Higher revenue. How did they beat the street? How was it that they beat the street? They beat the street by bringing down the loan loss reserves. How that translates into earnings, I have no idea. But the markets didn't buy it. It was very transparent, even for a person like me who doesn't believe, I don't trust fundamentals. I'm just not that type of trader. And that's the exact reason why. If I was to believe their fundamentals, I would have been buying JP Morgan. It's ridiculous. Meredith Whitney is so right. The analyst who called the bear market on the financials from the very beginning. She was so right. Don't buy these banks. She's predicting a second leg down, a retest, a second leg down for the financials, a double bottom formation, let's call it. So Tim Seymour on Fast Money, who seems to never be right about anything. What he does is that he says the day they come out and they report earnings, this is Alcoa. What's the stock of the day? In other words, he said to go buy Alcoa the following day. You'd have a big loss. He did the same thing with DRYS only a few weeks ago. It was at about 5. Yeah, rallied back some sense. But he was saying buy it back here. You would have had a loss going all the way down to 328. You would have to sit with this thing on Tim Seymour's recommendation. I mean, the guy gets paid millions, and he's wrong all the time. So it's just part and parcel. Failure is rewarded on Wall Street. It's amazing. Intel. I got the I got the alert when the earnings were released. It was a press release of the Newswire, and the best earnings ever recorded was the title on the press release. I said, "My God, I'm short." Well, obviously, the first reaction is that I'm going to get clobbered like a baby seal the following day, and sure enough, they sold it off. So what does this mean? I mean, Intel's earnings were pretty fabulous. Okay, we can't just deny it. Even AA's earnings were very, very good, or better than expected, I should say. Not very, very good, better than expected. What does it come down to? Why is the market rallying? I mean, Dougie Cash before early last week said that he predicted the market was going to rally. Why is Doug wrong? I mean, he's a bright guy. Why is he wrong? I mean, stocks are cheap, right? My prediction is this, is that they're going to get cheaper because sentiment in the marketplace is just so bearish. People don't want to spend. Take a look at Yum Brands that came out. You didn't hear much about this last week. They missed earnings. This is a China play, too. They missed earnings, and you didn't hear much about it, but the restaurants, the U.S. division did terribly. The Chinese division did okay. But one of the first sectors you want to look at to recover from a bear market are the casual dining sector, the casual dining restaurants. That means that the middle class is starting to come out of their cocoon, their bunker from getting hammered over the head in the market, watching their 401ks dissipate. They're seeing some recovery, so that they say, you know what, let's go out to Outback or one of the Yum Brand restaurants. And it's reflected in their stock price. So it's one of the early indicators of a recovery in the markets. And you're seeing this sector break down. I mean, yeah, 43.78 was the peak. 43.28, it's a lower high. That's a double top here. 41.61, this was announced before earnings, or this was hit before earnings, it failed. If you see a breakdown below 38.06, it's all over for the Yum Brands for a long time. Casual dining sector probably will go along with it. Apple. We were short Apple up until Thursday afternoon. We took profits on that trade. We made a healthy profit on that trade. We were trading the 200 puts on Apple. We're looking to get back in on the short side of Apple, and I'm going to leave this as a contest. I want to see if this works or not, if I get any response. I'm going to offer 6 months free to those members, or to those non-members who can guess what pattern is setting up here, and what am I looking for in terms of a signal to get short again. So 2 questions. What's the pattern that you see setting up? Second, what do we need as a signal to get short again? And if you get it right, then I'll offer you 6 months free on the Contrarian Trader. Shoot me an email. The first one to get it right will be that person. Send me a photo of yourself as well, and I'll post it on the website, on the homepage, so that it shows clear transparency. Somebody did win, and they did get that reward. If you're going to allow me to have your email posted as well, please feel free, but just give me the okay to put that on there, so that way somebody new comes to the site, wants to email you and say, hey, did he get it right? Was he honest with you? You can reply back and say I was. So that's the contest of the week. So we're going to be looking to get short Apple. I think Steve Jobs did a terrible job on that call on Friday. I don't know what he was thinking. Bad call. We remain short of the S&P 500. We remain short of the Dow Jones Industrial. We remain short of IWM. Big time short of IWM. And we have been short from back here. So we have a healthy profit. 2010 so far is shaping up to be a great, great year. The retailers, they are ugly. Expect them to get uglier. 10-year bond. Watch out for this bond, folks. We did see a breakout higher above the upper band of the downtrend line. It broke down below it again. Let's keep an eye on it. The 2-year bond broke down to its all-time high last week. All-time low last week. 2-year bond yield hit an all-time low. Very, very bearish. You want to see yields trade with the market. Baltic Dry Sea Index. The Obama administration, all they seem to want to do is tell us that the Jobs are growing. The global economy is growing. The International Monetary Fund, the global demand is growing. And tell me why the Baltic Dry Sea Index keeps hitting new lows. Would somebody please tell me that? Educate me. I've been quoting this sector, been trading off of this index for months. And it's a great index. I have made a lot of money by trading and using it as a confirmation of my accuracy on my trades, and it's been dead on accurate. I've been quoting it on my YouTube quotes. So stop listening to these thugs. Please subscribe to the 14-day free trial offer and get tonight's commentary. Please, I beg of you. If you're going to trade this market, be very, very cautious. We might, and I'm going to go into this in more detail in my numbers this evening, we might see a counter-trend rally here. I don't think it's going to last. So be wary on the long side. We are going to stay net short. We will trade to the long side at times. If we're wrong, we're going to admit we're wrong. We're going to cut our losses. We're going to get out. And that's it, folks. If you haven't subscribed to my YouTube